Hey everyone, it's Brandon from the Young Investors Podcast. Myself and Hamish are excited to bring you your weekly rundown of the latest business and investing news from around the world. A quick reminder before we get started that any advice provided by myself is general and does not consider your financial situation, needs, or objectives, so consider whether it's right for you. Brandon Kolk is authorised to provide general financial product advice in Australia and is authorised representative 1305795 of Guideway Financial Services Proprietary Limited, AFSL 420367. Please see the description box for my financial services guide. Past performance is not a reliable indicator of future investment returns, but with that said, let's get into another episode of the Young Investors Podcast. All right, guys, welcome back to yet another episode of the Young Investors Podcast. We're back again. How you going, mate?
I'm doing well. It's posted it. Last video I posted has finally got some extra traction, which is good. I had a couple of videos there that underperformed a little bit, but happy to finally see I'm back in the algorithm.
It's our first, always the first thing we go to is welcome back everybody. So what's going on? How's your business going? What's YouTube going? You got some videos that are pumping? What's going on? Just every week.
Yeah.
We're too involved. I feel like if we went for a 2-week break, we'd just be itching. We'd be what do we do?
Yeah. Well, yeah, I'd be lying if I said it wasn't what I think about, pretty much every moment I'm awake. So it's the first thing that comes to mind.
It does get like that.
Yeah.
It's almost I don't know. Working for yourself, I feel, is a blessing and a curse, because you don't there's obviously more upside in working for yourself, but at the same time, you're just constantly thinking about work. Yeah. It just doesn't stop. Yeah. There's never a moment where you're just 100% off. No. You're always thinking about something.
Yeah, you definitely enjoy kind of more of the flexibility of how you go about doing your work. But because, you're right, there's no kind of end point, especially with YouTube. There's literally no end point. There is always more you can put into a video. There's always more you could post. There's more frequently you could post. There's just a never-ending stream of things you could do. And so, it does kind of, you can become quite obsessive in periods of time, which is maybe not so great. But
the end point is you releasing a video crying that's titled "I'm quitting." That's the end point of every YouTuber ever.
Yeah, just crash out in spectacular fashion. Yeah.
Yeah. There is a lot of pressure to just continually work, because the algorithm just does not care if you're not there. Then too bad, so sad. But anyway.
Yeah, exactly.
What are we talking about today, Hamish? So we didn't do a podcast last week. Sorry, some stuff came up and we just couldn't get it done in the end. So we do apologise, but we're happy to be back again this week. But that means that we've got a lot to cover. So this will be, I think, an interesting podcast. It might even feel a bit like a speed round, because we got 6 or 7 topics to cover over the past 2 weeks.
Yeah.
So what have you got to cover?
Yeah, we'll start off, I think, with Nvidia Earnings, which just came out last night. So I think we'll cover that, because that's probably something that I think a lot of people are interested to see. For me, at least, it's always interesting to see how they've gone in the latest quarter, of course, with everything related to AI and the boom. I'm also going to talk through the RBA rate decision, the interest rate decision, which was, again, a news story from last week. I've got some other AI news related to Elon Musk that I'll talk through as well.
Oh.
What have you got?
I'll talk about just a little follow-up inflation story from our last podcast. Also, corporate delinquencies are on the rise. So we'll talk about some corporate bankruptcies. And also the 13F filings. They came out a couple weeks ago, but we haven't had a chance to talk through them. So maybe after you go through Nvidia Earnings, I'll talk through some of the 13F filings. Because there was some interesting stuff in there and some not so interesting stuff, so I'll talk about it all in a bit.
Well, with that said, today's episode is brought to you by Seeking Alpha, your one-stop shop for stock analysis, market data, and news. Access expert analysis and news for thousands of stocks. View buy, hold, and sell ratings from members, Wall Street analysts, and Seeking Alpha's own algorithm. Screen for stocks using a variety of fundamental and technical analysis metrics. Access 10 years of financial data and company filings, and manage your portfolio by tracking your investments investments with price alerts so you never miss a buying opportunity again. Click the link in the episode description or head directly to seekingalpha.me/young investors to try Seeking Alpha free for 7 days.
Nice. All right, Hamish, hit us.
Let's see.
Nvidia. So what's the backstory? I guess Nvidia's at something like a 54 PE, very hyped stock, right? And but at the same time, their earnings have been going up, right?
Yes, so Nvidia's of course been one of the biggest beneficiaries so far of this AI boom, supplying these kind of very high performing H100 graphics chips, particularly to Meta, Google, these kind of big Microsoft, OpenAI, these companies that are trying to build out these massive data centers to train and run these large language model AI models. And so, they've been one of the biggest...
And these chips cost like $30,000, $40,000, $50,000 each, right? Don't they?
Yeah, well, I think we don't know exactly how much, they're obviously paying, with the specific deals that they have with some of these companies. But you're right. If you go on like eBay, for example, these chips are so much, there's so much demand and desire for these specific chips that some of them have been selling on, eBay and these other websites, secondary markets, for 20, 30,000 US a chip, which is crazy. And it means, of course, it's very likely that at the very least, companies like Meta that are buying, hundreds and thousands of these chips are paying 10,000, 15,000 a chip, maybe even more. And so, that has been the story of Nvidia over the last couple of years now, as their business has gone from being relatively niche and certainly small in terms of data center chips being sold by the company to now basically being a data center chip company. And so I'll walk through the fourth quarter results and then the full year results. So in the fourth quarter, and this is financial year 2025 because Nvidia is living in the future. Revenue of $39.3 billion, which was up 78% year over year. Data center revenue of that was $35.6 billion, which was up 93% year over year. So almost all of their revenue now is just from these data center chips, these AI chips. Gaming and AI PC, but it's mostly kind of gaming chips. Revenue came in at $2.5 billion, which was actually down 11% year over year. But it is kind of funny because the gaming, that $2.5 billion gaming revenue stream used to be the biggest segment of their business just a few years ago. So it is kind of funny to see it absolutely dwarfed by the data center revenue.
I did a video on Nvidia recently talking about their just meteoric rise. And I looked back to 2015, then 2020, and now where we are starting out 2025. And back in 2015, Nvidia was a graphics card company. That's like all they did. And they made something like, I think, 3 or 5 billion in total revenue. Yeah, it's like that's it. And now it's like I don't even know. Revenue in the quarter of, as you said, $39.3 billion. So, and it's not off the back of selling more graphics cards to the gamer nerds out there, is it?
No, it's not. And then they do have two other segments, professional visualization, and then they have another segment called automotive and robotics. Each of those produced about $500 million in revenue. So very, very small categories. So their business is like 90+% data center revenues, and then their gaming chips as well. Their gross margin, I thought I'd mention this because it's quite astounding, is 73%. So a 73% gross margin, which is essentially the price of their products above like the raw material and delivery costs, not even all the other operating costs, is 73%. And that obviously is massive, which gives you an indication that they have some pricing power. They might just have some, they might just have something unique in their products that people are willing to pay well above and beyond compared to kind of other chip makers that probably wouldn't be able to slap a massive markup on what it costs for them on the material costs. So That's obviously very impressive. Net income, so their profitability came in for the quarter at $22.1 billion, which was up 80% year over year. Earnings per share came in at 89 cents, which was up 82% year over year after some share repurchases. Founder and CEO Jensen Huang said, "Demand for Blackwell is amazing as reasoning AI adds another scaling law, increasing compute for training makes models smarter, and increasing compute for long thinking makes the answers smarter." And so essentially indicating or speaking to the point that as these AI models become more sophisticated, the demand for their data center products is also increasing in a meaningful way. In terms of the full year results for the financial year 2025, revenue came in at $130.5 billion, which was up 114% year over year. Of that 130 billion, it's actually insane. But of that 130 billion, 115 billion is data center revenue, which again is almost all AI chips. And again, even to even narrow it further, it's almost all coming from Meta, OpenAI, XAI, I think it's called, which is Elon Musk's company, and Microsoft. All of these companies now essentially handing Nvidia more than $100 billion a year for these chips, which is kind of astounding.
That's wild. Yeah, it makes sense though as to why Nvidia got so shaky when that DeepSeek stuff came out, and they said, "Oh, we've done something comparable to ChatGPT, and we've run it off of only really cheap, outdated Nvidia hardware." It totally makes sense why that caused such a blip. Because you're right, like having, what did you say the gross margin was? 70-something percent.
73. Yeah.
73. That's literally just Nvidia saying, "It doesn't cost us very much to make these, but we're going to charge you a load, an absolute ton of cash." So, it makes sense. I mean, all this hinges off of whether it's actually the secret sauce, right? If Nvidia's chips are the secret sauce, then it's all good because they'll continue to be able to charge whatever the hell they want, and people still buy it. The only problem is if it's not the secret sauce. Or if somebody else also figures out the secret sauce.
Exactly.
Then that margin comes under pressure.
Exactly right. And so 115 billion in data center revenue. Their gaming revenue for the full year was 11.4 billion. So again, mostly data center revenue. Net income for the full year came in at 72.9 billion, which was up 145% year over year. Earnings per share came in at $2.94, which was up 147% year over year. And they're not really expecting the growth to stop. So they gave an outlook for the first quarter. So next quarter, they're expecting $43 billion in revenue, which is quite a big first quarter. And so 43 billion is what they're expecting, which is I guess the growth is slowing. Fourth quarter was 39 billion, but they're still expecting continued growth. And in terms of the market reaction and valuation, which you kind of alluded to at the beginning, I just wanted to mention, despite all of these kind of fantastic looking results, the stock is actually down 1.5% in after hours. Right. And so maybe that's changed over the days between when we're recording this and when this is released. But the immediate market reaction was basically nothing. The stock didn't really move. In fact, it went down a little bit. And so, you might wonder, well, their profits just went up 150%. How is it possible that the stock is not up heaps? The truth is that just all of this, and you alluded to this at the beginning, all of this growth has just already been expected. These are the massive expectations that the market has been placing on Nvidia, to the point where the market is already expecting 150% profit growth. And in terms of how the market values the company, it's valued at $3.2 trillion. So even with their latest profit figure of $73 billion, that's still a 44 price to earnings ratio. The stock is 44 times their annual earnings, which means even after all of this fantastic growth, I think it's more than 100% revenue growth for the last 2 or 3 years in a row, something like that. The market is still expecting them to post big growth in the future. Not even just maintaining these, 100 billion plus a year revenue run rate in terms of data centers, data center revenue and selling these chips, but to also go even further beyond that. And so the expectations are still very, very high for Nvidia.
Expectations are great. Yeah, exactly. That's exactly what I can't add any more to that. That's exactly right. They just have to keep going and going and going. Like that's the thing. Like if they stop, if they don't meet the expectations, see you later.
Yep.
Stock will get completely re-rated.
Yep.
And I feel like, I don't know, I feel like there will be a day of reckoning for Nvidia. It's just, I don't know when that is, because investors, like, they'll keep posting these results, and then investors, they're not going to be like, oh, okay, good now. They're going to be like, we want to see that again. We want to see that again. And eventually, like, it's just the natural S curve of growth. Eventually, Nvidia will hit a point where they're like, guys, I don't know what to tell you. Like, we've had a good run. And as soon as they say that, the stock's like,
goodbye,
bang, straight down.
Yeah.
Now it might still go up hundreds of dollars per share or something. Like, I can't say when this will happen, so I can't make a comment on whether it's a good or bad investment decision. But that's generally the way that I would say that stocks work, or high growth stocks work.
Yep.
Is that investors just expect more and more and more, and then eventually they come to time where they go, well, actually, and then everyone's just like, nah, I don't know.
Yeah.
So I feel like there's something like that coming in Nvidia's future somewhere, but who knows?
Yeah, who knows? Exactly right.
Crazy.
Do you want to take us through some of these 13F filings that we missed a couple of weeks ago? Actually, now these results have been out for. Well, I shouldn't say results. The filings have been out, and I took a quick look at some of these filings when they were released, but I didn't take the time to go actually deep into them. So I'm actually curious myself to see what's been happening.
Yeah, and I haven't gone like properly deep into them because a lot of these investments I just don't follow. But there were a couple of things to kind of jump out at me from the 13Fs. And I'm making a full video on it for the channel as we speak. But really, unfortunately, the main trend this time around was that there wasn't really too much going on. That's just the sad reality. Li Lu did nothing. Buffett really didn't do much at the very top end of his portfolio. Didn't do much, but I'll get to Buffett. Guy Spear actually did nothing. So there was a lot of doing nothing. But there were a few people that did some stuff. So Michael Burry, I'll start with him. He has that big bet on the Chinese tech stocks, right? So he reduced 25% in Alibaba, which was his biggest holding. He held Baidu steady, which is his second largest holding, and then he reduced 40% in JD, which is his third largest holding. But it's a bit of mixed signals in the Chinese tech stocks because he also added in the quarter, he added Pinduoduo, which is now his sixth largest holding. So he's trimming Alibaba, he's trimming JD, but at the same time, another e-commerce company, Pinduoduo, he's chucked into the portfolio. And I honestly think that the main reason for this is because of the rise that we saw in Alibaba and in JD.com. We've seen it. It's not relevant for this 13F filing, but we have seen it a lot in Q1 of this year. So I would probably expect the trend of Burry selling down these stocks to continue, because particularly Alibaba has just skyrocketed in Q1. But you can also see that trend in Q4. You can see JD and Alibaba still having pretty good patches in that quarter.
He's definitely very confident in the in some of the cheaply valued, I think, Chinese companies certainly relative to the US market, which is much more richly valued. In terms of his actual portfolio size as well, it did actually shrink again. So I don't know if that plays into why he kind of trimmed some positions. So the amount he actually has invested in US equities fell again.
Yeah.
So, which
and
could be
I
for a
still
variety
think
of
he
reasons. But
yeah, he'd still hold a lot of cash, or be doing a lot with his other dollars. He's not fully invested by any means. So yeah, that was Michael Burry. Bill Ackman, he continued to add to Nike. That was the kind of big story a couple quarters back now.
Yeah.
He added 15%. It's now his 6th largest holding. Hamish, sorry, what were you going to say?
You finish with Bill Ackman, and then I've got something to add as well that I just noticed.
Oh, okay.
Yep.
Yeah. No worries. So he continued to add to Nike, 15%. He reduced 14% in Chipotle. That's his 3rd largest holding.
Yep.
Fair enough, because I wrote here that's a good move so far as the stock has continued to slide so far in Q1. It's down around 20% now from its Q4 high. And that's really all there was to say out of Bill Ackman this time around. What were you going to say, Hamish?
Yeah, so the interesting thing about the 13Fs is they come out kind of 45 days after the end of the period, and that's usually the first time we get to see these moves that these investors have made, because they want to delay it as long as possible so that they can acquire their position. But Bill Ackman sometimes does like the opposite, and he actually did that this quarter, where he actually announced voluntarily a very large investment that he made in the first quarter that we don't see yet in the 13F filings, but he just voluntarily announced it, and so that was an investment in Uber. So he's taken a $3.6 billion stake in Uber, which we will see in the first quarter filing, which is in like 3 months' time. And so usually these investors like to acquire as much as possible, like behind the scenes, before having to announce it. But yeah, Bill Ackman, I don't know, he likes telling everybody after he's made a position.
He does.
There's nothing dodgy about that at all. Nothing to read into it.
Maybe he hopes he's got a little mini Buffett effect or something.
Yeah.
Hold your horses, Bill. Hold your horses. Calm down, mate.
Yeah. You're not him.
So, yeah, interesting. I completely missed that bit of news. So that's the first time I'm even hearing about it. Maybe I need to be trawling the news sites more frequently. There you go. All right, I'll go to Klarman next. Only one notable change. He added quite a bit to Restaurant Brands International, which is now a $189 million position. Occupies the 7th position in his portfolio out of 21. But there's nothing really to note at the top of his portfolio. Monish Prabrai continued to add to the coal stock. He was just moving and shaking a little bit. He added 2% to his biggest US bet in Alpha Metallurgical Resources. He added 144% to Warrior Met Coal, but he did reduce 22% in Core Natural Resources and sold out of Arch Resources and Danaos Corp, which is one of the largest independent owners of modern large-size container ships. So a little bit happening, but he's still very much continuing with his bet on metallurgical coal stocks. Howard Marks had a bit of an interesting quarter because he was just selling everything. I can't remember. He trimmed his portfolio reasonly substantially, but I just chucked in the actual visual for you, Hamish. I know you won't see this if you just listen to the audio, but can you see a trend in the Howard Marks in the Oak Tree portfolio? Yeah, there's just a lot of red.
There's quite a lot of red.
Yeah,
there's quite a lot.
It's like, to be fair, like some of them are trimmed by 0.68% or 1% or 3% or something like that. But a lot of the positions just, whether it's coincidental or intentional, he did reduce in a lot of his positions in the quarter, so he's scaling back the portfolio a little bit. And then the last one, the last 13F I wanted to quickly cover as well is Mr. Warren Buffett himself. And like I said at the start, there really was not very much to report in this 13F filing at the top end. The biggest change by far was a 14.7% reduction to Bank of America, which is his 2nd largest holding. Yep. He also, at the pointy end of the portfolio, he continued to add small amounts of Occidental Petroleum. An interesting move, which happened a little bit further down the list, was Berkshire added quite a bit to their Domino's Pizza position. They added 86%. It is now a $1 billion bet. But I think the main story, well, in the media, there were really two main stories. One was that he stopped selling Apple, so the Apple position remained the same. So I feel like that story is kind of put to rest now.
Yeah.
But the other story I've been seeing floating around, which I think is crap, is everyone's running with the headline that Warren Buffett has sold out of his S&P 500 index funds, Hamish. Did you hear? He's sold his Vanguard, he sold VOO, and he sold his SPY position.
He doesn't believe in it anymore. He hates the US now.
He's going to start shorting the market.
He's done.
He's totally contradicting what he's always said. And then if you use your brain, Hamish, which I know you're quite good at, you'll notice that these two positions changed his portfolio each by 0.01%.
So meaningful. So meaningful.
So you get all these media, all these articles saying that Warren Buffett has just sold the market. Does he think a stock market crash is coming? Blah, 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 blah. And that's the title of my YouTube video, by the way. No, definitely not. But in reality, it's shifted his portfolio from here to here.
Yeah. But it does make a good title. And that's all that matters.
It does make a good title, Hamish. It does. Yeah. I made a joke in my YouTube video in the script that like a better title for these articles would have been like, Billionaire Buffett sees quarter on the ground, doesn't pick it up.
Yeah, like essentially, yeah.
Yeah, it's pretty much what the news story is. But anyway, so yeah, they're the 13 Fs. If I had to sum it up, there wasn't much going on. So
yeah, not much
fanfare this time.
Nothing too exciting this quarter. Maybe next quarter. I know that at least some point in the next, if I'm being really safe, at some point in the next 10 years, 5 years, there will be there'll be some chaos in the markets, and we'll get to talk about Buffett dumping a lot of money into stocks, hopefully. But we don't have a timeline on that.
Yeah, you kind of allude to a point there. That's kind of the biggest point you can take away, is that what we're looking at with these 13F filings is like the best investors in the world. So it kind of gives you a little bit of an insight as to what they think about the stock market at the current time. If they're really not doing very much, then kind of shows you. And I mean, Warren Buffett has been much more frank and just said very upfront that we're not finding any opportunities in this market. But even just having a look at what everyone else is doing too, it kind of suggests that there aren't that many killer opportunities right now where something crazy is happening in a sector or an industry or across the market and everyone's piling into something in particular. There's not any of those stories happening at the moment.
Yep, exactly. All right,
Hamish, back over to you. What can you tell me? What don't I know?
Yeah, let's jump over to, hopefully you know a little bit about this, but let's jump over to Australia for a second and talk about the RBA rate decision. So the Reserve Bank of Australia decided to cut interest rates for the first time since 2020 last Tuesday. The central bank announced a 25 basis point reduction in the official cash rate to 4.1%. So they did a 0.25% reduction, quarter point reduction in the official cash rate. The RBA feels that inflation has been brought down to a low enough level, which currently, I just had a quick peek at it, currently sits at 2.5%. So Australian inflation has been, essentially brought back down into that healthy 2 to 3% range. RBA Governor Michelle Bullock said some of the upside risks to inflation appear to have eased, and there are signs that disinflation might be occurring a little bit more quickly than earlier expected. There are nevertheless risks on both sides. And so, the RBA is fairly confident that not only is inflation down at a healthy level, but that it's continuing to decrease at a rate that is actually beyond what they expected. In terms of that last comment about there being risks on both sides, there are a couple of other kind of economic data points that probably played a role in the decision to cut rates. The first was that wage growth has also been slowing, which you would expect once you start raising interest rates, but you don't want to let that. You don't want to let the economy grow too slowly, and so reducing interest rates makes sense. And the other point is, of course, that Australia has been in a per capita recession for 7 straight quarters now. And so, even though on a headline basis, the Australian economy has been growing a little bit each quarter, when you divide it by the number of people in Australia, we've been in a recession for quite a while. So that's also an important point to note.
Great.
Bullock also said, "I want to be very clear that today's decision does not imply that further rate cuts along the lines suggested by the market are coming." So she just wanted to be clear that the market, which is expecting a number of more rate cuts over the coming months, that is not necessarily a guarantee. Director at CoreLogic, Tim Lawless, also echoed this expectation, saying we shouldn't get our hopes up for a rapid or significant rate cutting cycle in the near term. The RBA is likely to remain alert to data flows with persistently tight labour markets, a weak Australian dollar, and elevated levels of global uncertainty remaining as downside factors that are likely to keep the loosening cycle a gradual and cautious one. And so, everyone gets a slight cut to their mortgage rates, but it's still a very minor change to monetary policy.
It's crazy how, if you're Australian, you would definitely know, but this has been like the financial news story over the past couple of weeks.
Yeah.
And it's crazy how hung up everybody gets on 0.25%. But there you go. I mean, it's one of those things where it's like, you can argue that it's significant. You can also argue that it's pretty insignificant. For some people, it is very significant. Like for people really, really struggling, paying their bills, paying mortgage, whatnot, having any sort of relief is welcome. But in the grand scheme of things, for the amount of fanfare that it gets in the media, the actual significance of it is not that high.
No, not really. Yeah.
There you go. But it happened. Rejoice, everybody. My mortgage just got slightly cheaper.
Fantastic.
Great. I'll enjoy my couple of bucks. All right. Well, I'll continue on with some inflation news coming out of America. It says here, Fed officials are worried about tariffs' impact on inflation and see rate cuts on hold, minutes show. This is from a week or so ago. Policymakers on the Federal Open Market Committee unanimously decided at the meeting to hold their key policy rates steady after 3 consecutive cuts, totaling a full percentage point in 2024. So the federal funds rate is now between 4.25 and 4.5%. It's in that mid-range. But they are holding steady. Federal Reserve officials in January agreed they would need to see inflation come down more before lowering interest rates further, and expressed concern about the impact President Donald Trump's tariffs would have in making that happen, according to the meeting minutes released last Wednesday. In reaching the decision, members commented on the potential impacts from the new administration, including chatter about the tariffs, as well as the impact from reduced regulations and taxes. The committee noted that the policy is, quote, significantly less restrictive, end quote, than it had been before the rate cuts, giving members time to evaluate conditions before making any additional moves. The president has already instituted some tariffs, but in recent days has threatened to expand them. Yes, this is kind of, a follow-up to, I think we were talking about this in our last podcast.
Yep.
So it's basically what we were talking about. It's now the FOMC coming out and saying the exact same thing.
Yeah, the tariff suggestions and actual implementations have just continued to come through. It certainly didn't stop with it started with China and Canada with like 25%, and then they were paused. And then what did we see? There was like steel and aluminium, and then I think they've just continued. All different kinds of tariffs have just continued to come in. And so, it's been quite a lot.
FOMC members cited, according to the meeting summary, quote, the effects of potential changes in trade and immigration policy, as well as strong consumer demand. Business contacts in a number of districts had indicated that firms would attempt to pass on to consumers higher input costs arising from potential tariffs. They further noted, quote, upside risks to the inflation outlook. In particular, participants cited the possible effects of potential changes in trade and immigration policy. Yep, that makes sense. So I'm just quickly scanning to see whether this just keeps repeating itself or whether there's anything else. Not too much else. Yeah, participants indicated, provided the economy remained near maximum employment, they would want to see further progress on inflation before making additional adjustments to the target rate for the Fed funds rate. That makes sense, right?
Yeah.
If everyone's still got jobs and there's no crisis that we're responding to, if inflation's still the concern, then you wouldn't jump to lower interest rates, right?
No, exactly. And I think a lot of it really comes down to, again, it's not really clear whether these Trump tariffs are kind of temporary pressure that he's wanting to put on certain countries to get better deals in terms of trade, or whether it's a part of a more broader strategy, as he has suggested at times, to make tariffs a main revenue source for the federal government and kind of reduce or get rid of the burden on income taxes, on individual income taxes. And so I think that's going to be the question we'll see. And at the moment, it looks like he is wanting to keep some of these tariffs in place, at least for now. The Canada and Mexico 25% tariffs have been paused, but he has recently, I think this week or the previous week, indicated that he's going to go forward with them, that they will be unpaused. And so
right.
What initially seemed like just a kind of a pressure point to get some get some more favorable deals, especially regarding kind of border protection from on the Mexico side. It seems like he's planning on keeping those tariffs in place. And so, that does start to raise questions about, well, will these businesses just pass the 25% on straight to consumers, which is what pretty much what economics, at least the economic theory would suggest, that at least most of it's going to be passed through to customers. And so, that's obviously a big factor that the Federal Reserve has to consider. Yep,
definitely. The article finishes nicely. On the flip side of worries over tariffs and inflation, the minutes noted, quote, substantial optimism about the economic outlook, stemming in part from an expectation of an easing in government regulations or changes in tax policies. So there you go. That is our inflation follow-up for the US. Tell me about this AI news coming out of Grok. Grok, what a name.
We've been hearing a lot, obviously, about OpenAI and ChatGPT and what they're putting out, and we hear about we hear about Gemini and we hear about these kind of front runners, Claude, Anthropic, that actually I think released a new model as well this week, which I'll talk about maybe at the end. But we don't hear that much about Elon Musk's kind of AI model. But we did get a massive announcement. Again, this was a couple of weeks ago in regards to, his model, Grok. So Elon Musk's XAI on Tuesday last week unveiled its latest artificial intelligence model, Grok 3. And it actually claimed that it can outperform offerings by OpenAI and China's DeepSeek based on early testing, which included standardized tests on math, science, and coding. So Grok 3, which had been in development for several months, was optimistically slated for release in 2024, but slightly missed that deadline. I think that's the first deadline Elon Musk's ever missed, right? I don't think he has a history of missing deadlines. Like usually he's, right on the
exceptionally reliable.
He slightly missed the deadline. This is it. Look, in Elon Musk time, that's pretty good. If he said it was going to be released in 2024 and it comes out in February of 2025, and not February of 2028, that's pretty good.
He's nailed it.
He's nailed it. So they, in a presentation that was kind of in a live stream they did on X or on Twitter, X AI essentially showed that they've been building and using this enormous data center in Memphis, which contains 200,000 GPUs to train Grok 3. And so it's quite impressive, this building that essentially just stores and operates 200,000 GPUs. And so, they essentially in their presentation claimed Grok 3 beats GPT-4o on benchmarks including AMY, which is a benchmark that evaluates kind of mathematics. It also did very well on, or it actually beat GPT-4 on another benchmark, GPQA, which assesses models using PhD level physics, biology, and chemistry problems. And so they're at least claiming that it is now the best reasoning model, with a pinch of salt, knowing that benchmarks aren't everything. But these are some of the benchmarks that OpenAI and DeepSeek have been using themselves to say, hey, we've got the best model. And so it's quite interesting to see. In terms of their reasoning model, Job done, exactly. In terms of their reasoning model, there's two models in the new Grok 3 family, Grok 3 Reasoning and Grok 3 Mini Reasoning. And they can think through problems similar to reasoning models like OpenAI's O3 Mini and Chinese AI company DeepSeek's R1 model. So many confusing names to all of these models.
All I'm thinking is that if Elon Musk is running this in his brain, I hope the reasoning model is improved.
Yeah, exactly. If he's got this hooked directly into his brainstem. Let's hope that it's working. It was actually quite funny. They actually introduced a button called Big Brain, which users can use to access additional compute power for complex reasoning questions, which is so on brand for Elon Musk to call it something like that.
The Big Brain button.
Yeah, exactly. They announced.
I'm feeling lucky.
No, exactly. And they announced a voice mode that should be coming in the coming week, similar to what ChatGPT has. For their pro or premium subscribers. They announced Deep Search, which again is just very similar to OpenAI's latest model, which allows you to search the web and will do research for you. I had just kind of a brief kind of takeaway from watching this, and also now from seeing what happened this week, which I'll talk about in a second. But it still seems like there's really no clear winner, and I'm interested in your take on this maybe, but there seems to be like no clear winner or leader in AI yet. It seems like one of these companies comes out with a model and it beats all the benchmarks. And then a few months later or weeks later, the other company comes out with their latest model and it beats all of the benchmarks. And it seems like they're all kind of doing the same thing, but like they're kind of just slightly apart. And what happened this week actually kind of backs that up, because Anthropic, which has the Claude AI model, released a new reasoning model and it beat all of the benchmarks. And so it does seem like they're all kind of doing the same thing, but they're just staggered in terms of when they're training these models and the level they're able to achieve. At least that is if you're to believe the benchmarks, if they're to be believed as like a good way to assess the models. So I don't know. It's kind of interesting.
My vibe is definitely what Mark Zuckerberg said, where he's just like, we don't exactly know what we're doing yet, but we just know we don't want to be left behind. I feel like that's just all of them, to be honest, because they are all generally making the same thing.
Yeah.
It's like you don't need 10 different variations of the same product, which is like a kind of multi-purpose chatbot, really. So
yeah,
I think we're just like at that initial stage, the initial stage of the internet, where just nobody really knows what the hell how this is going to turn out.
Yeah.
There's no like very clear indicator that we need to go down this way or this way or this way. They're just kind of all doing the same thing, all just like experimenting, making sure that no one gets left behind, just trying to keep up with the Joneses kind of thing.
Yeah.
But yeah, you're right. I mean, I imagine eventually, because if they all compete doing the exact same thing, that's not going to work. You can't have like 10 of the identical product and expect all of them to have like equal market share. There'll probably be like one or two that will kind of end up winners. What I see so far is like them finding a niche to go down. Like maybe one is just like the bomb when it comes to coding. And then it becomes like known as the coder's like AI system.
Yeah.
And it kind of holds that niche. Whereas another one's like, oh, this is just the best at writing, or this is the best at doing reasoning and writing, like ChatGPT, for example. Or this one is like the best at generating art and images and video and blah, blah, blah. And they kind of each find their own place, but I don't know. Or it could be like a competitor that we don't even know about yet, or maybe doesn't even exist yet. I mean, I think it's just such early days that we don't really know what's going to be best.
Yeah, it's so early days. I mean, the thing that I think about, if I was thinking about this from an investment perspective, is what if they all just race each other and it gets better and better and better, and then it just gets open sourced, and then it's just there's no actual value in all of the money they've spent getting to that point, which is kind of the risk that the DeepSeek model kind of brought out, which was regardless of how they trained it, it's open source and it was competitive with ChatGPT. So, we could be a couple years down the line and these models are insanely good, and then there's just an open source version that kind of defeats the purpose of all of the spending on chips. And the other takeaway I have based on that is Nvidia must be just loving all of this. Like, again, just being the one selling the shovels, or selling whatever, to let the other companies gamble on how much money they think they can make from these models, and we'll just supply the chips and let them do it.
What's that? Facebook found some gold over there? Oh, what's that? Google found some gold over there?
Yeah.
Pickaxes, everybody. Pickaxes.
Yeah.
Get your pickaxes here.
Get the golden pickaxe.
$100,000 a pop. Exactly.
Yeah. That
is what it is. It's like selling the how do you say it? Selling the shovels in the gold rush or something like that?
Yeah.
Yeah. That's what it is.
Pretty much.
Yeah. There you go. I'm getting a bit tired, mate. How are you feeling? You holding up?
I'm holding up, yeah. What else have we got?
We got one more story. I'll go through it quickly and then maybe we'll call it after that. Corporate delinquencies. I know this is what your preferred late night reading. But, for those that don't already know about this, like Hamish, I know you're already fully caught up.
Of course, yeah.
I thought I'd just talk through. This is a. I like reading the Daily Upside. That site. It's just like I love it because their news articles are always short and they're always just funny. You can like literally read it in 2 minutes. So this is one of those ones that I saw on the Daily Upside. Not sponsored in any way, just an interesting website if you haven't seen it before. New data on corporate loans doesn't make for soothing bedtime reading. This is what's been keeping you up, Hamish. Even with a booming economy and stock market in the past 2 years, credit card delinquencies and auto loan defaults have reached decade-plus highs. And now US companies are missing loan payments at the highest rate in almost 8 years, according to new data. Corporate credit has been a sturdy and dependable revenue source for banks in the wake of the pandemic, especially compared with other forms of lending. After COVID, restrictions on defaults were lifted. Credit card and auto loan delinquencies almost immediately spiked in 2023, with households burdened by a highly inflationary environment. Commercial real estate defaults also skyrocketed, given the semi-permanent pivot away from pre-pandemic professional life. But corporate delinquency rates have risen much more slowly. However, even their reliability appears to be slipping, if only a little. Corporate borrowers were more than a month or more late on $28 billion in debt payments to banks at the end of 2024, according to new data collected by analysts at Bank Reg Data and reported by the Financial Times last Monday. That marked an increase of $2.2 billion in the fourth quarter and $5.4 billion year over year. So the delinquency rate on loans by American banks to domestic and foreign companies rose to 1.3% at the end of last year, which is the highest since the first quarter of 2017. So not a super high rate, but I guess this is probably what you would expect, right? Now that interest rates have gone up, are staying up, companies start to get put under the pump. Maybe they have a bit in the bank that starts to get depleted, and now it's really starting to catch up with some of them.
Yeah. Well, honestly, I think it's kind of shocking that rates went up from basically 0% to whatever they peaked at in the US, like 4.5%, 4 point. 5.5. Yeah, 5.5, 5.75, something like that. Like they went there within like 6 months, a year, something like that. It's kind of shocking that that there wasn't just a massive flood of defaults from companies that were relying on free money, essentially, which there are a lot of just unprofitable businesses that were just kind of skating by. I think, what do they call them? I think like ghost companies or something, where like they're essentially just they're just kind of skating by just borrowing more and more money. I think that's what they're called, but I might be misremembering.
Right.
But it is kind of shocking that at least I think for a lot of people that that there wasn't this massive surge in bankruptcies. But yeah, I guess there has been like a small increase recently.
Yeah, you raise a good point, actually. That does make sense. It was quite a quick rise in the interest rate, so you would expect that to do more damage than, I guess, what it did. And yeah, to kind of further on your point, the thing that I wanted to stress is not to make it seem a bigger deal than it is, because what did I say? Corporate delinquency rate, it's like 1.3%. And that's the highest since the first quarter of 2017, right? But in prior periods, commercial and industrial loan delinquencies are still historically low. In the 2008-2009 crisis, they got up to 4.39%. And after the tech bubble burst, they got up to 3.9%. Right. So 1.3% isn't a crazy number, just to give that context. But yeah, it is interesting to see economics play out, I guess, as interest rates are rising and are staying a little bit higher. So there you go.
Yep, there you go. All
right. Done.
Well, with that said, thanks everyone for tuning in. As always, thanks to Seeking Alpha for sponsoring this episode. Again, if you want to check out Seeking Alpha, you can by clicking the link in the episode description or heading to seekingalpha.me/young investors to try their 7-day free trial. We'll be back next week. Thanks, Brandon, for joining me, as always. And yeah, we'll see you guys in the next episode. See you later, guys.
All right. See you later.